What if I told you that 3 simple investment funds could pay you $15,000 every single month without you lifting a finger? No boss, no deadlines, no trading your time for money. Just passive income flowing into your account like clockwork while you sleep, travel, or spend time with the people you love. Today, we're breaking down the exact 3 ETF strategy that could replace your full-time income with $15,000 in monthly dividends. We're talking about real numbers, real funds, and a real roadmap that everyday investors are using right now to build financial freedom. Let's get one thing straight right off the bat. This isn't some get-rich-quick scheme. This is a wealth-building strategy rooted in proven dividend investing principles. The 3 ETFs we're about to explore are battle-tested, backed by billions in assets, and designed to do one thing exceptionally well: pay you consistent growing income year after year. So what are these 3 powerhouse funds? We're talking about SCHD, JEPI, and VYM. Each one brings something unique to the table. Think of them as the 3 pillars of your income empire. SCHD gives you dividend growth, JEPI delivers high monthly cash flow, and VYM provides rock-solid diversification across hundreds of America's best dividend-paying companies. Together, they create a portfolio that balances income, growth, and stability in a way that no single fund can achieve alone. Now here's where it gets interesting. These 3 ETFs aren't just randomly chosen crowd favorites. They're strategically selected to complement each other perfectly. When you combine them in the right proportions, you create a dividend machine that generates reliable income while protecting you from market volatility. Let's dive into the first pillar, the Schwab US Dividend Equity ETF, ticker symbol SCHD. This fund is legendary in the dividend investing community, and for good reason. SCHD tracks an index of high-quality dividend-paying stocks that have consistently increased their dividends for at least 10 consecutive years. We're talking about companies with staying power, companies that have weathered recessions, market crashes, and economic uncertainty while still rewarding their shareholders year after year. SCHD currently yields around 3.8% annually. Now I know what you're thinking. 3.8% doesn't sound like much compared to some other high-yield options out there. But here's the magic. SCHD's dividend has grown by nearly 6% annually over the past several years. This means your income doesn't just stay flat, it grows. Every single year, you're getting paid more than the year before. That's the power of dividend growth compounding over time. The expense ratio on SCHD is an incredibly low 0.06%. That means for every $10,000 you invest, you're paying just $6 per year in fees. Compare that to actively managed funds charging 1% or more, and you're saving hundreds or even thousands of dollars over time. Those savings go directly into your pocket, accelerating your path to wealth and financial freedom. But here's what really sets SCHD apart. This fund doesn't just chase the highest yields, it focuses on quality. The companies in SCHD are evaluated based on cash flow, return on equity, dividend growth rate, and dividend yield. This rigorous screening process ensures you're investing in financially healthy companies that can sustain and grow their dividends for decades. We're talking about household names like Chevron, Merck, Pepsi, and Texas Instruments. These are proven winners. Now let's talk about the second pillar, the JP Morgan Equity Premium Income ETF, ticker symbol JEPI. This is where things get really exciting because JEPI is an income powerhouse. This fund currently yields around 8% annually, and it pays dividends every single month. Let me say that again. Every single month, JEPI deposits cash into your account. No waiting around for quarterly payments. This is monthly income you can count on like a paycheck. JEPI uses a unique strategy that combines equity investing with options overlay. Basically, the fund invests in high-quality large-cap stocks and then sells covered call options on those positions to generate additional income. This strategy allows JEPI to deliver significantly higher yields than traditional dividend ETFs while still maintaining exposure to blue-chip companies like Microsoft, Alphabet, and Nvidia. Over the past year, GP has paid approximately $4.72 per share in dividends. If you own 1,000 shares, that's $4,720 in annual dividend income from this single fund alone. And remember that income arrives monthly, giving you consistent cash flow to cover expenses, reinvest, or simply enjoy life on your terms. The beauty of GEPI is that it smooths out the volatility that often comes with equity investing. While the stock market might be swinging wildly from day to day, GEPI's option strategy helps cushion those ups and downs, delivering more predictable returns. This makes it an ideal choice for investors who are transitioning from accumulation to income generation. Now imagine waking up on the first of every month knowing that thousands of dollars are about to hit your account, regardless of whether the market went up or down. That's the psychological power of monthly dividend income. It transforms your relationship with money and gives you the confidence to make decisions based on what you want to do, not what you have to do to pay the bills. Let's move to the third pillar, the Vanguard High Dividend Yield ETF, ticker symbol VYM. If SCHD is about quality dividend growth and JIPI is about high monthly income, then VYM is about bulletproof diversification. This fund holds over 560 different dividend-paying stocks, giving you exposure to a massive cross-section of the U.S. economy. VYM currently yields around 2.5% annually. Yes, it's lower than both SCHD and JEPI, but that's not the point. VYM's role in this 3 ETF strategy is to provide stability and broad market exposure. It tracks the FTSE High Dividend Yield Index, which focuses on large-cap companies that pay above-average dividends. The fund's top holdings include giants like Broadcom, JP Morgan Chase, ExxonMobil, and Johnson & Johnson. What makes VYM special is its sheer diversification. With over 500 holdings weighted by market capitalization, you're not putting all your eggs in one basket. You're spreading your investment across financial services, technology, healthcare, consumer goods, energy, industrials, and more. This means if one sector takes a hit, your overall portfolio remains stable because you're diversified across the entire economy. The expense ratio for VYM is also incredibly low at 0.06%, matching SCHD and making it one of the most cost-efficient ways to gain exposure to high-quality dividend payers. Over the long term, these low fees compound in your favor. Now here's where we put it all together. How do you actually build a portfolio with these 3 ETFs that generates $15,000 per month? Let's do the math. $15,000 per month equals $100 to $80,000 per year. To figure out how much capital you need, we divide your desired annual income by the average yield of your portfolio. If we allocate our portfolio strategically across these 3 ETFs, we can achieve a blended yield of around 5 to 6%. Let's say we aim for a blended yield of 5.5%. To generate $180,000 annually at a 5.5% yield, you would need a portfolio valued at approximately $3.27 million. Now, I know that sounds like a big number, but stay with me because this is where the real magic happens. You don't need to have $3 million tomorrow. This is a long-term strategy built on consistency, discipline, and the power of compound growth. Let's say you start with $50,000 and commit to investing $2,000 every single month. With an average annual return of 10%, including both capital appreciation and dividend reinvestment, your portfolio would grow to over $1 million in just 20 years. Keep going for another 10 years and you're well over $2 million. The investors who reach financial freedom aren't the ones who try to time the market or chase the next hot stock. They're the ones who show up consistently, invest regularly, and let compound growth do the heavy lifting. Boring? Maybe. Effective? Absolutely. Let's talk about how to allocate your capital across these 3 ETFs. A smart allocation strategy might look like this: 40% in SCHD for dividend growth, 40% in GPI for high monthly income, and 20% in VYM for diversification and stability. This gives you a balanced approach where you're capturing growth, income, and broad market exposure all in one portfolio. With this allocation, your blended yield would be approximately 5.6%. On a $3.2 million portfolio, that's roughly $180,000 per year, or $15,000 per month. You'd be receiving quarterly dividends from SCHD and VYM, plus monthly dividends from JEPI, creating multiple income streams throughout the year. But here's what makes this strategy truly powerful. It's flexible. You can adjust your allocation based on your personal situation. If you're younger and still in the accumulation phase, you might tilt more heavily toward SCHD to maximize dividend growth. If you're closer to retirement and need immediate income, you might increase your allocation to JEPI. And if you want maximum stability and diversification, you could boost your position in VYM. Now let's address the elephant in the room. What about taxes? Dividend income is taxable, and depending on your income level and tax bracket, you could be paying anywhere from 0% to 23.8% on qualified dividends. This is why many investors hold these dividend ETFs in tax-advantaged accounts like Roth IRAs or traditional IRAs. In a Roth IRA, your dividends grow completely tax-free, and when you withdraw them in retirement, you pay zero taxes. If you're investing in a taxable brokerage account, you'll want to be strategic about tax efficiency. Qualified dividends are taxed at lower rates than ordinary income, which is one reason why these ETFs are so attractive. The dividends from SCHD, JEPI, and VYM are generally considered qualified, meaning they benefit from preferential tax treatment. Here's another key insight. Reinvesting your dividends during the accumulation phase supercharges your results. When you automatically reinvest every dividend payment back into purchasing more shares, you're buying more income-producing assets. Those new shares generate their own dividends, which buy even more shares. This creates a compounding snowball effect that accelerates your wealth-building journey. Let me paint a picture for you. Imagine you're 25 years old and you start investing $500 per month into this 3 ETF portfolio. You reinvest all dividends. Fast forward 40 years to age 65. With a conservative average annual return of 9%, your portfolio would be worth approximately $3.6 million. At a 5.5% yield, that's nearly $200,000 per year in dividend income. But here's the secret that separates dreamers from achievers. You have to start, not tomorrow, not next month, today. The single biggest enemy of wealth building is procrastination. Every month you wait is a month of compound growth you'll never get back. The investors who build life-changing wealth are the ones who take action, even if they start small. Now let's talk about risk. No investment is without risk, and it's important to understand what you're getting into. The stock market can be volatile. There will be years when your portfolio drops in value. There will be moments when you question whether this strategy is working, but history shows us that over the long term, quality dividend-paying companies tend to recover and continue growing. One of the biggest advantages of dividend investing is that it gives you income even when stock prices are falling. During the 2008 financial crisis, many dividend stocks cut their payouts, but funds like VYM and SCHD focus on companies with strong balance sheets and sustainable dividends. These companies weathered the storm and continued paying shareholders. Another risk to consider is concentration. While VYM gives you over 500 holdings, SCHD holds around 100, and JEPI's portfolio is more concentrated in large-cap names. Dividend investing gives you a fighting chance to not only preserve your wealth, but grow it faster than inflation. Are you Team SCHD for that dividend growth, Team JEPI for that juicy monthly income, or Team VYM for that rock-solid diversification? Let me know, and let's keep building wealth together.